as an investor, this is where you should be looking at your portfolio and going, just a couple of weeks ago, I was about to light my hair on fire because of that sell off in the market. I was losing all this money. I was panicking. I was sitting up at night. And now this market's rallying. You're like, woo, yay. Market's going back to new highs. Don't do that. This is the opportunity right now to go back and go, okay, I remember how I felt during that decline. That means I had too much risk in my portfolio. This is the time to start rebalancing some risk, raising some cash, taking some positions off the table that aren't working, maybe add some positions. It's okay to add some positions, but add things that have been less impacted by what's been going on in the markets.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week, joined as usual by my good friend, the mellifluous portfolio manager, Lance Roberts. Lance, how you doing?
I'm doing fine today. How are you?
I'm doing well. Look, I picked mellifluous because Lance, this audience just tells me its favorite thing in the world is to listen to you talk, but also because I think the markets, stock seems to like what they're hearing Trump say lately. So we're going to talk about that in just a moment. Real quick, you weren't here last week, and your partner in crime there, Michael Leibowitz, pinched hit, and he was great as usual. But you were in New York, and I think you were there to do a segment with Charles Payne. How'd that go?
It was good. It was a very long day. Left at 3 a.m. in the morning. Unfortunately, I picked the one day with bad weather. So I got delayed an hour going, got there an hour late, had to rush over to the studio, do the hit, and rush back to the airport to get on the plane. An hour delay there, waiting on the weather, got home. And because of the weather back in Houston, we sat on the tarmac for an hour waiting for a gate to open up. So I didn't get home till like 11 o'clock at night. And that is a very long day, just with all the traveling back and forth.
I'm sorry. Part of it's probably getting older too, but I used to love to travel when I was younger, and I wanted the business opportunities that would let me travel. Now I do everything I can to avoid getting on a plane, and not just for the hassles that you talked about, but I was listening to the I don't know if he was the head of transportation or whatever, but they unveiled a whole new system that they are planning to build for air traffic controllers going forward, and to listen to them talk about how just incredibly antiquated our current system is so frightening. And then they put up and they put up the visuals. They're like, hey, these kids today that we're trying to attract new talent, and they're playing like state of the art video games with the best graphic cards in the world, and then we come and ask them to work on this, right? And it looks like it's straight out of like war games or what was the Atari Asteroids, that Atari game.
No, it really is pretty interesting. But, it's funny because my kids, when they hear that my wife travels a lot too. And so when she's traveling, the kids are like, oh, it's so exciting. You get to travel, go and see these places. And she's like, no. And I try to tell my kids is like, when I was younger, I spent about almost 12 years 13 years living overseas. So I literally lived out of a suitcase, and it's fun. It's exciting for about the first 3 months, 4 months. And that gets really old after a while. And now I'm just like you today. I do everything I can not to travel. And even when my wife says so my 60th birthday is this coming Monday. And so she's going to take me to London for my birthday. And I'm like, honey, I love you dearly and I appreciate that, but I don't really want to travel. I don't want to go anywhere. And she's like, oh, we have to, we have, we're older now. We need to go travel and see the world. And I'm like, A, I've already seen it all. B, just the whole idea of traveling just terrifies me.
So you're like, honey, can we go to Paris, Texas instead?
Exactly. Yeah. Can we go downtown and have dinner? That's a far trip for me too. So, but no, it's all good.
It's all good. All right. Well, I'm sure there's a lot of people watching here who can relate. So anyways, we got a lot to talk about this week. Real quick, I just want to remind folks, because this is happening in parallel with this video. If you're watching this video, the day it's coming out, Rick Rule, as mentioned in the video released earlier this week, is running one of his gold boot camps this week. Sorry, today, Saturday. And if you haven't signed up for it yet, you can still, it runs all day. So you could watch this video and then jump into that live. Or you could just still purchase it and then get all the replay videos and watch it, at your heart's content later on in the week. So if you want to do that, or at least check it out, just go to thoughtfulmoney.com/rule bootcamp, and you'll be sent to where all the information is. All right, so I talked about how the stocks were liking what the Trump administration is saying, and Lance, it's funny. Last week with Michael, I put up a couple of comments from our discussion the week before, where we were going through a bunch of Trump policies, and I really took pains to tell people, look, and we're not taking a partisan approach here. We're just reacting to what's going on by the administration that's currently sitting in power that impact the economy, right? And tons of comments in the comment section by people who got triggered. And I contrasted because it was about 50-50. There were comments saying that, well, Adam's gone, full-blown MAGA now, and there were comments saying, well, Adam's a clear socialist, right? So shows that I think hopefully that we are succeeding and maybe charting a middle course here. But folks, we're going to do the same here. None of this is again, trying to take any sort of personal stance here. I probably will say some things that might sound a little complimentary. I'm definitely going to say some things that sound critical. So hopefully, again, we're charting that middle course. But there's been, go ahead.
It is just so ridiculous that you've even got to say this to people these days. I did political talk for 8 years on a radio station here in Houston during the Obama administration, and even about halfway through the first Trump administration. And, it's very interesting that, during the Obama administration, we could have a political conversation. And, whether you agreed with people or disagreed with people, it was all just a conversation. And you say, well, look, I disagree with you because of this point or that point. And nobody got up in arms. Nobody got their tits hurt, right? So it was just, you could have a normal conversation with somebody and talk about and discuss the benefits and faults of different political decisions. And it's just a shame now that you've got to sit there and to have a discussion about something that impacts the financial and monetary lives of every single American, that you've got to qualify that. It's like, hey, I might hurt your feelings. Man, buck up, people. You're an adult. You can have a conversation about something that you disagree with and not get your feelings hurt. Because look, if your feelings are getting hurt over something that somebody says, political or otherwise, you've got other problems to deal with. So, let's all be adults in the room and let's just have a conversation about what's going on policy-wise. Is it good for the markets? Is it good for the economy? Is it good for you? Yes or no? And if you don't agree with it, figure out why you don't agree with it and make sure you're right.
Yeah, and the thing that I usually say if I chime in, in the comments with people that are particularly wound up, it's like, look, you totally welcome your opinion. I would love to hear the data-driven refutation of the point that was made, right? So if you have anger, channel it into trying to articulate why you disagree with the policy part that's being argued here. Now, that being said, a couple of things. One, I don't want to lecture this audience. I think in general, Lance, we've got a great audience here. 99% of the people, I think, actually come here for that type of neutral, thoughtful discourse on both sides of an issue. But there's always the small but very vocal, minorities on both ends, right? And part of this, I think, what's different from your early days doing this on radio is one, the country has become a lot more polarized. I mean, like it or not, just the data shows that, right? And Trump is a polarizing figure. I mean, that's an objective comment, not a subjective one. But also, social media has really arrived, right? In the Obama administration, it was kind of in its infancy. Now it's the cesspool that it is, right? Where people just feel like they can blame whoever they want to from the anonymous position of their keyboards, right? So anyways, I'm not saying anything people don't already know, but I appreciate your call to like, hey, let's just keep the conversation about the facts of the issue and try to put our hurt feelings aside if we can as adults.
Well, and again, the whole problem with getting up in arms about something is you stop listening. Right. And again, this was when, a great example of this is when the Obama administration launched the Affordable Care Act. And that was a very polarizing issue at that particular time. People don't remember it that much now, but that was—
I do.
Right, yeah, you do. But we had plenty of conversations about that. I interviewed congressmen, I interviewed senators, both sides of the aisle. We had discussions about, the problems and implications of the Affordable Care Act. In particular, was one of the issues of putting people with pre-existing conditions into the insurance pool. Because
Right.
what we said then was, is as soon as you do that, you're going to upend the whole way an insurance pool works, and you're going to send premiums skyrocketing higher. And so if you're complaining about healthcare costs today, the Affordable Care Act is what did that to you. Because you combine these insurance pools of high risk people with pre-existing conditions into a normal insurance pool. If you don't understand how insurance works, that's the first thing you need to figure out. So, but we could have that conversation. People didn't get all upset, and you could have a thoughtful dialect about it, and then people would walk away and go, okay, let me go think about this. And they still may disagree with you, but at least they were willing to listen. The problem today is when you get as soon as you ramp up your feelings, you stop listening. And you will never figure out if you're right or wrong if you stop listening to the conversation.
Yeah, yeah, and look, in our safe space culture where everybody demands that they get to live in a bubble where they hear nothing that makes them feel uncomfortable, right? Just it's toxic to that kind of conversation. But hopefully, Thoughtful Money is one of the platforms where we can still do this.
Right.
So, anyways, back to what the markets are liking that they're hearing. So, the Trump administration, it's had this sort of high stakes high noon style approach to its trade strategy. A lot of people, understandably debating whether this is just pure chaos or whether this is, four-dimensional chess. And whichever side you're leaning towards, there is some progress being made this week, right? So the Trump administration did announce its first big trade deal. It's with the UK, world's sixth largest economy, US's fourth largest trading partner.
Yeah.
And so, starting to put points on the board, right? Continues to say, look, there's 17 other major trading partners that we're still in talks with, but they're coming along well and expecting to see more of these deals struck soon. So this is the first proof point. And as part of the UK deal, British Airways just announced today that they're going to buy 32 Boeing long-haul planes, right? So already there's some immediate, stuff we can point to say, hey, trade's beginning to happen that wasn't necessarily happening before. So anyways, we'll see what happens from here. Very importantly as well, there's a lot of back and forth about US and the big player on other player in the chessboard, which is China. And administration saying, well, we think they're going to come to the table. We think we've got the stronger hand. China says, no way, nobody's talking. We can withstand this. But this week, it was announced that China is willing to talk. And so, Treasury Secretary Bessent is flying, I think, to Europe to have conversations. To where?
Bye.
Dubai. Okay, sorry, Dubai. To have conversations with the Chinese delegation there. We'll see what happens, but at least clearly they are now talking. Some people interpret this as a sign of panicking, but China basically shut down most of its economic data reporting. And a lot of people think it's because they don't want the world to see how injured they're getting from the 145% tariffs that have been put on China so far. And speaking about those tariffs, just a couple hours ago, Trump just put out, hey, you know what? I'm bringing it down to 80% because that feels appropriate right now, right? So I think it's a little bit of an olive branch in front of the meeting in Dubai. I think Trump, the fan base would say, hey, look, Trump's just showing that he's the one calling the tune here, right? He's not sweating. China's coming to talks. That lets Trump, change the game board a little bit more by bringing the tariffs down. So we'll see what happens from here. But I think, this is a week where the administration can say, hey, look, on this trade stuff that everybody's really been telling us we're screwing up, like we're making the kind of progress we want to be making. Time will tell what comes of this. But anyways, markets seem to be, relieved by this. And we talked, Lance, about, if additional trade deals start getting struck, that's probably going to put some more additional support under today's market, correct?
Well, so first of all, let's back up because Liberation Day was April the 6th. That was when these tariffs were announced. Here it is, May the 9th. And the first deal that you get done is by far the only deal you got done, which should not have had a tariff to begin with because we have a trade surplus with the UK. So this was all about trade deficits. So this was by far the easiest deal to get done in terms of creating a tariff negotiation. And this is kind of like, taking a test at school where they go, put your name at the top of the paper. Great, you passed. This was the simplest one to do, and it took them a month to do that. So, again, if it took a month to get one trade deal done, and the easiest by far, the second easiest would be McDonald Island to negotiate with the Penguins. But this was the easiest deal to get done. Japan, China, France, Germany, these are going to be much tougher deals to negotiate. And this is going to take a very long time to work through this. And, again, like I told you before, it was a huge mistake following Peter Navarro's lead on these tariffs and the way they approached this. Markets were holding up fine at a 10% tariff. They expected it. And then they kind of went off the rails with this tariff negotiation. So, now they're trying to figure out a way to work themselves back out of that problem. They realize now they're in a trap. They've created their own trap and turned these tariffs. And now I've got to work my way back out of this through hopefully getting some negotiations done. And you finally got China to come to the table to negotiate. Good move by Trump to sit there and cut that initial tariff to 80%. That's going to have to come down a lot before this is all said and done. And in order to get a deal done with China, that tariffs from probably have to get to probably 10 to 20%, somewhere in there. We'll see what happens. But China is a very critical trading partner to the U.S., and so he has got to get a deal done with China. That's really the only one that the markets care about more than anything else. And so a lot of this rally we saw was really not anything other than the 90-day pause on tariffs, and it gave the market enough breathing room to basically reposition back on portfolios. Retail investors came in hard and bought that dip. So we'll see if they're right or not. Institutional and professional investors haven't really bought this dip a whole lot. They're expecting another leg down here. So we'll and we go through the technicals here in a few minutes in the market, but this is a very tenuous position for markets. And this is going a whole lot slower than what the markets were initially expecting. So, how markets deal with that going forward, or what the Trump administration does between now and the next Fed meeting or the Fed meeting after that will be interesting to see.
Okay, I'm going to push back on a little bit of that, and again, not because I'm trying to deliver any sort of pro-administration message here, but
this is adults having a conversation.
This is adults having a debate, right? So first off, the markets. I mean, you kind of say like, oh, the markets really got spooked and everything, and they did, but the markets are back to where they were pre-Liberation Day, right?
Yeah,
so
because you put the tariffs on pause. So those tariffs went away. We're back to 10%.
Yeah, but they're not gone.
Yeah, they're gone.
No, they're not gone. They're theoretically coming back if we don't strike these memoranda of understanding, right? So it's
those tariffs are never coming back. I will tell you this right now. What is going to happen is either he's going to cut deals, or we're just going to stop talking about tariffs.
Yeah. But I don't disagree with you, right? Yeah. I mean, I think the tariffs were largely a negotiating tactic, right? There was the stick, and then he's offering all these carrots behind the scene, and strike a deal with me, I'll be real generous, right? And we talked about this. I mean, I think, yeah, I won't go into all the details that I've said in the past, but I think the main part of this whole trade strategy was Trump just to be able to say, I got something better than what we had with all these other countries. And even more importantly, I got them on Team America as we're going after China, right? Sure. So I think it's really, so first off, I think the markets are okay, right? It's not like this has been a colossal mistake, right? Because the markets are essentially flat.
No. What I mean by mistake was the markets had given him a green light for 10% tariffs. And
I totally agree with you. He caught the markets by surprise. Some would say total communication fail. Trump would say, this is me using strategic uncertainty to my advantage. I want to keep everybody on their heels. You can have your opinion one way or the other, right?
When I mess something up around the house, I come up, I was like, honey, I meant to do that, but I'm going to fix that. Don't worry.
Yeah, exactly. So now the UK deal, and I'm just listening to mostly to the administration here, so maybe I'm just getting sold the PR stuff, right? But spent a lot of time saying, hey, look, this was a deal that folks were trying to make for 25, 30 years. We couldn't quite get it done. They did open important parts of the UK market that hadn't been open to American producers before, particularly on agriculture, right? So there are some wins there. And also there's a 10% tariff now on the UK where there wasn't before. So I don't think it was like the falling off a log, write your name at on the top of the paper and you get an A plus type of deal. I'm not trying to say it was, the world's greatest trade negotiation either.
Right, I'm just saying that was the easiest negotiation that you're going to have out of everybody.
Probably.
Next to the Penguins. I mean, next to the Penguins, this was the easiest negotiation.
Yeah, yeah. So I agree. And look, I think, look, I'm totally willing to say, look, I mean, as of 48 hours ago, I was saying like he better start getting some trade deals struck, or the market and all key players are going to start losing patience with this, right? So I think this was kind of an important win to put on the board, and he did. So congrats to him. Now, what's going to happen? Over the next couple of weeks, are we going to see a lot more of these, which would give a lot more momentum to this, or are you right? Well, we did the easy one, but all the rest are way too hard, right? And I think it's also really important, as we've talked about, don't expect like trade deals to be struck. In fact, I was kind of surprised at the amount of detail that was announced in the UK deal. I think what you're going to see for a lot of these other countries are more memoranda of understanding, right? Like we're agreeing on these 2 or 3 key points, and it's probably going to be like bring tariffs down to X or remove them or whatever. And everything else is going to get negotiated by our teams over the next 1 to 2 years, right?
Yeah, no, that'll be a lot of it, and again, look, this is all fine stuff. The one thing that worries me about the market rallying so hard over the last 3-4 weeks is that you've now emboldened the administration to be more aggressive with tariffs, because it's like, okay, the market's come back, I've got some breathing room, so I can really kind of play hardball here. And what worries me is that that bit of overconfidence is going to put the markets back into a bad position, because he's going to be too aggressive in the negotiation rather than focusing on getting a deal done. And again, this is just my assumption.
Yeah.
Now that he has that kind of that weight off of his shoulders of the market going down, the bond market kind of really getting pressured. Now that the majority of that has been resolved, that now he's going to negotiate much tougher than he might have otherwise, which may put markets back in jeopardy again. We'll see.
Yeah.
But again, that's the only thing that does kind of concern me.
Okay, I want to ask you a question about that. First, I just want to underscore something that you said, which was there was a headline came out this morning saying from Goldman saying that the only material buyer of this dip from Liberation Day was Mr. and Mrs. Retail. So to your point, Lance, it doesn't seem like the institutional investors, the smarter money, has a lot of confidence in this rally. So you got to be careful here for that reason. And you as a capital manager with clients, your job is to make sure you don't lose money, right? So I understand your concern about if the administration were to get so emboldened that they became even more strong-handed in their tactics and then spook the markets even further or break something or whatever. So I totally get that. We can talk about the odds of that. I'm just curious. Let me just ask you as like a citizen of the U.S. here. If this is an opportunity to right some, very lopsided issues between the U.S. and China, would you be willing to take a material hit to the stock market in the near term to get to a better future in terms of trade relations, reshoring making the American economy more resilient on a going forward basis? Like, would that be an acceptable trade-off to you personally?
Well, so first of all, nobody has really explained to me in simple terms, and maybe you can do this for me. And I'm being a little bit facetious here, but
Sure.
just follow me through. You're asking me as an ordinary citizen. So I'm not me anymore. I'm just average mom and pop in America trying to raise 4 kids, get them through college. I'm just
Yep.
work every day.
You're one of our viewers. You're
right. So I'm not a capital manager. I'm not guy into economics and all this other stuff. I'm just the average American. Nobody has ever explained to the average American what's so unfair between our trade relationship with anybody. Right?
Yeah, well, I think in the case of China, look, and I've made this case. I think I've made it 2 weeks ago here with you that I think one of Trump's more strategic blunders in communication on the trade thing was, I think folks realized, okay, yeah, he doesn't like how things are going with China during the campaign. I don't think folks were prepared that like I am basically going to, you know, shake the entire chessboard of global trade in my first 100 days and go after China directly. I think people were like, well, wait a minute, I wasn't really sold onto this yet, right? And they're scrambling to get on the board.
Right. I get all that, right?
Yeah.
That's not my question. Though. My question is what was so bad? What was the deficit to me as the average American about the way trade was with China 4 months ago versus the way it is now?
So what I have heard, and I don't purport to have all the pieces of the puzzle here, but one, super hard for American businesses to do business in China, right? So we buy a ton of their stuff. They buy a lot less of our stuff. Yes, their population isn't quite as wealthy as ours, but it's more because they have all sorts of non-tariff trade barriers there. You hear that term an awful lot. A lot of IP ripoff. It just you listen to guys like Kevin O'Leary, the Shark Tank investor, has been real vocal on this about kind of I mean, a lot of American businesses agree with him, but he's been real specific about the issues of why China has been such a bad actor on the world trade stage with not just America, but with a bunch of other countries. And he talks about like, look, if you get a product, if it gets to, I think like 5 million in sales, he's like instantly there appear like 40 knockoffs, right, that have just ripped you off your IP. And there's like a very tried and true process there by which, any successful product around the world kind of gets copied. Now, Trump would say, look, again, he doesn't fault China for this. He faults previous U.S. administrations, but we've outsourced critical manufacturing of products that are essential to our way of life here in the U.S., right? Whether this is pharmaceuticals, whether this is drone technologies, chip technology isn't so much China, but it's other places. Rare earths, obviously, we're wicked dependent on them for our rare earth supply. So there's a lot of things that COVID sort of unveiled where we said, look, we're way too reliant on them for these things, right?
Right. Now you're talking about, so you and I agree with all that, right?
Yeah. And then the last thing I'm just going to throw in is fentanyl, right? That's another big issue.
Right. So, but the average mom and pop in America doesn't know any of that. Here's what they know. They know that I need to buy stuff to support my kids, support my family, whatever it is, and I can only afford so much. And so, yeah, for decades now, companies have made the conscious decision. Boeing. So when you think about airplanes, the most important part about airplane design is the wing design and the tail. And that is like the one thing that you protect proprietarily more than anything else. And Boeing shipped it out to China to have it manufactured there cheaper and gave up the design structure to China to get it done there cheaper. So in order for companies to sell their products as cheaply as possible to create bigger profit margins, and this is all about the pursuit of profit, nothing else, we have chosen to do business with another country that we willingly knew was going to steal our IP, was going to take the IP, manufacture their own products, they're going to manufacture them cheaper, they're going to steal the technology, etc. We willingly did that because we were in the pursuit of profit margins in the US, because we wanted to sell our consumer base the cheapest possible product of stuff they don't need, right?
Yep.
The US economy is 70% consumption. We are all driven by consumerism. Every time you pick up social media, every time you open up a website, you turn on the television, what do you see? It's one ad after another ad. And pharmaceuticals are the biggest ones now. I mean, you can't watch a show on television without 15 different, pharmaceutical ads coming up to promote some drug for, everything from, hair loss to, eczema. So, it's just one thing after another that is all being driven to sell people product of stuff they don't really need, right? But we've got to have it because I saw some influencer on TikToks that says, I need to have this type of toothpaste, or I need this type of tool, or whatever it is they're promoting. We've just driven that into people. Get more into debt. The banks are all behind this as well. Here's a credit card. You really can't afford it, but here's a credit card, and I'm going to charge you interest on it, but you can go buy stuff. Here's your buy now, pay later programs. It's all about driving the consumer base. And so this whole idea of, oh, China's bad, we need to fix this relationship, it's been bad for decades, right? But it's been the backbone of the economic capitalism in the US. And so the risk, and this is what mom and pop are going to have to figure out, is that if you rectify this relationship, the way you want to try to rectify it, and you want to reshore all this manufacturing back into the US, average mom and pop in the bottom 80% of America can't afford it.
Right. Well, so I disagree with nothing that you said there. Right now, I think there's enough part of, we'll say, the base that voted for Trump that at least understand. I think at least understands a lot of American jobs were outsourced, right, for a profit motive, right, get prices down, global, take advantage of globalization,
Export deflation.
and we have lost. That has eroded the middle class lifestyle here, right? So I think they get okay. We start righting some of these wrongs. We start bringing jobs back to America. We're probably not going to bring the sweatshop jobs back. I don't think anyone's really super excited about that. But we're going to start making some more of these critical things here. We'll make more cars here. We'll make more pharmaceuticals here. I mean, things that can generate a good middle class lifestyle. So I think they get that math. Now, of course, you have to deliver on that, right? So if the cost of living is going to go up because you're manufacturing things here, which costs more, wages better go up at least by as much, if not more, to offset that, right? I think people kind of get that simple math, but it has to be delivered upon.
But let's roll that back for a minute, right? Because see, this is the challenge. Because again, what's the one driver for Wall Street? Profitability.
Profit, yeah.
And we've currently got record
profit to Wall Street. I don't think Wall Street cares about Main Street, but profit to Wall Street is what Wall Street cares about.
But everything that you buy comes from, I mean, how many people do you know have an Apple iPhone? And how often do they upgrade to the next iPhone? Even though the next iPhone that comes out really isn't that much better than the last iPhone, they got to have the thing, right? This is all back to the point.
Right.
So the problem becomes is that in order to manufacture here, and this goes back to our whole carrier industry, discussion we had previously about when carrier industries brought the plant back from Mexico into Indiana, they got rid of most of the jobs. This is going to be the one saving grace of artificial intelligence is we can get rid of a whole lot of labor. We can manufacture stuff here because of AI, because AI doesn't cost anything. Once you implement AI, there's no more cost. But I heard an interesting statistic about that today is that they said AI is going to create a massive expansion of GDP per capita, right? So what's GDP per capita? That's economic output divided by the number of people in the population, right? That's GDP.
I just so you know, I agree with everything you're saying, and I agree with that point, but I agree with the point you're about to make about it too.
Yeah, which is, the people using the GDP per capita is not going to be equally spread. This is the big when you hear people talk about GDP per capita, it makes it sound like everybody in the U.S. is equally participating in that GDP per capita.
Right.
That's not.
I live in a small little street with like 4 homes. Yeah. If a billionaire moved into one of them, our net worth per capita, we'd all be 100 millionaires, right?
Exactly. And so there's a huge,
but he'd have all the money.
right. These are huge faulty statements that are made because when you start talking about the middle class, the average American just trying to make ends meet, this all sounds fantastic. The problem is that we have had to be able to export inflation to import deflation for the past 40 years in order for people to survive and to live the lifestyle that they want. This is why when you go to other countries, the median lifestyle is not what it is in the United States. If you make $30,000 a year here, you're in the top 1% of income earners in the rest of the world. So, we've got to have as adults in America, we're going to have a real serious come to Jesus meeting at some point with our financial situation and go, we can't afford to live in, big houses and have multiple cars in the driveway and have big screen televisions in every room and everybody's got an iPhone and everybody in the family's got an iPad. That's going to have to go away.
Yeah. But so I agree with everything you're saying. Let me just say, go ahead.
In order to maintain profitability, you cannot raise wages to meet the cost of living standard that will be cost by manufacturing in America.
Okay. This is worthy of digging into more, and I'm sure we will in future discussions here. I just want to note, before November, right? The trajectory we were on had a terminal date on it, right? Like the status quo, if it continued, with our deficit spending, our debt, the plight of the U.S. consumer.
That's not true.
No, plight of the U.S. consumer. Like as it went on, things
Yeah,
were.
next 150 years, it won't be in any of our lifetimes. Yeah, there's a terminal date on it, but it's so far out there, it'll be 2 or 3 generations down the road. And
I guess it depends what we mean by terminal here. But my point is that like the trends were not in favor of the average household's prospects, right? On a median basis. You're disagreeing with me.
Yeah, that's not true at all. The median prior to November, or even now, the average American has a lifestyle standard that's way above that anybody else in the world. So,
sure, yeah. If you're comparing us to, yeah, but I'm saying in terms of like what the middle class lifestyle, can afford, right? We're definitely seeing a degradation.
Right, and look at the middle lifestyle, kind of lifestyle, right? They're homeowners. They have 2 cars in the driveway, a pool in the backyard. They've got, multiple televisions.
Well,
they have smartphones. They've got access to technology. They've got access to healthcare. They've got access to food whenever they want. There was a great video by this lady out the other day. She was out in California, hated America because America is so racist. So she moved to Africa.
Africa, yeah, I'm totally there. So, all right, finish this point, and I'll jump in.
And she realized very quickly just how good her lifestyle
was. Yeah.
So there's all this fear mongering out there. It's like, oh, the debts, the deficits, none of that. There's not one bit of that argument that is factually true anywhere.
No. But come on. So, because you and I talk about this all the time, right? Like, on average, people who are our kids' generation age, they face a tougher challenge than we did. We didn't quite have as good. Pardon me?
That's not true at all.
In terms of like,
when I grew up in the 60s, the average salary was about $13,000 a year. Right? Average salary today is $70,000.
Yeah, but what's the average house?
It's
a much higher price.
The average house was about 25 grand back in the 60s.
Yeah, so 25 grand, so 2x your income.
Right, and this is just, but that is just a function. And we've created the housing price issue right now. It's like, oh, I can't afford the houses. Well, you can thank the Federal Reserve for that, right? You can fix the housing problem pretty quickly, but you've got to stop doing 3% Fannie Mae loans. You've got to start going back in the 60s, the 70s, the 80s, the 90s. You had to have a 20% down payment to buy a house, period. And because when you do that, you require people to have a 20% down payment, there's not a massive amount of buyers that can afford to buy a house with 0 down or 3% down through a Fannie Mae. So you remove the demand for houses. And when that occurs, the housing price comes down because it's all about supply and demand. So you've got to get back to a normal economic environment where it requires a balance of supply and demand relative to that. So you can fix the housing problem pretty quickly, but it's just you're gonna have to go through some pain first.
In theory, and it's gonna be super painful. And I think we should do it. But here's my point. And all right, it's good that we're having this debate. Look, it is legitimately harder to afford a middle-class lifestyle now than it was in the previous relative generations, whether it's the cost of housing, whether it's the cost of cars, whether it's the cost of education, certainly whether it's the cost of raising children, right? So
back all that up though, because again, here's what you're missing. In the 60s, 70s, the 80s, what was the middle class lifestyle in those periods? Right?
Let me get to my point, and then you can finish this point.
The average house was 1,300, 1,400 square feet, 3 bedrooms, 1.5 bath. You had 1 television in the house. You probably had 1 car. If you were really doing well, you had 2 cars in your driveway. There was no cell phones. There was no internet. There was no, computer video games. There was no all this other stuff.
Yeah, I'm about to make that point. But also too, you didn't have 2 cars because both parents didn't need to work.
Right, but my point is that when you look at the middle life lifestyle today, everybody has this assumption that they're supposed to be afforded all this stuff. My middle class lifestyle is I have to have an iPhone, the best iPhone. Yeah. I've got to have a laptop. I've got to have a really nice car. I've got to be driving a Tesla or a Mercedes, whatever it is. I've got to have a 4,000 square foot house. I've got to have an Xbox in my living room, flat screen television. Those are wants. Those are not needs. Those are not requirements. Those are not, I mean, it's just, the middle class lifestyle has gotten so convoluted through consumerism over the last 15 years. That's your problem because
So
nobody's a realistic view of what a middle class lifestyle should look like.
it is a big part of the problem. It is not the full part of the problem. And look, I mean, I'm so on this side that you're making here. I literally, we had some young 20-year-olds over for dinner the other night, and we went through this whole thing about like, well, gosh, when we were your age, we lived above a garage. We had about 300 square feet. I mean, I understand some of the creep that you're talking about, and it is a factor, but we may just disagree here philosophically. I think it is legitimately harder. It is a steeper mountain to climb with this younger generation, given the cost of living worldwide here. And I'll let folks chime in the comment section because I think they're going to be on my side here. But let me make this one point and I'll let you go. Because the point I've been trying to get to is the administration has been so first off, yes, we could be doing things differently, both as a culture and as a nation, how we govern here, right? If we could change the way we do loans for houses, right? Like you were talking about. To me, that's what I was saying about we've got all these unsustainable policies and trends that are leading us down this path. And if you listen to like Besant, he has said like, look, we have optimized the American lifestyle around buying cheap stuff from China. And he's like, I don't think that's a guaranteed part of the American dream. Like he has basically said that Trump made the probably don't need $30. You can have $2, right? So maybe this is the inklings of and I think that this is part of what's going on here, which is Trump trying to start to do the heavy surgery to right size this 40-year, profit motive incented kind of increasing, making the country more vulnerable in the pursuit of the quick buck, right? That you were talking about earlier, right? So, we may be at the point here where there's, the attempt to have an adult sort of like, look, all right, we got to stop doing some of these things. They're just not in our national best interest. There's going to be some pain with that. And we have to ask ourselves as a culture, what do we value as a culture? Do we value being able to buy the cheapest thing at Walmart, right? Or, do we value a little bit more quality of life, national security and resiliency, and maybe, changing our lifestyle a little bit where we don't need, it's not about how much crap we have, but it's about the fewer things that bring us more value, in our lives.
Well, and also too, don't forget is that part of this problem we're talking about is also a parental problem because
It's a cultural, for sure.
Because you and I talk about this all the time. How many kids did we send to college over the last 20 years to get sociology degrees? Those the degrees that are not, in the development side of the economy. We used to have, when I was growing up, you had shop class, right? You went to shop, you learned to weld, you learned to pipe fit, you learned to, work on cars, whatever it was. There was an interesting article out just 2 days ago. It was in the Wall Street Journal. There are juniors in high school that are being offered $70,000 a year jobs coming right out of high school because they can weld.
You go in the trades. Yeah, absolutely. And what's interesting on that is it's not just the trades anymore. Did you see Peter Thiel's? I can't remember what he's calling it now, but it's basically like an apprenticeship where,
Yep.
Hey, don't go to college, apprenticeship or fellowship. You come work for us. We're going to guarantee you get these experiences, in your first couple of years. And then at a minimum, you will have made a good deal of money and learned a bunch of valuable skills, right? So, yeah.
That's a huge difference. When we go back to the 60s, 70s, 80s, 90s, right? It was declining, but in the 60s and 70s, we were 80% manufacturing, and that's been declining. We're 20% now. That shift from manufacturing to services is what eroded the middle class's ability to maintain their lifestyle. So through parental choices, we started, and I remember this growing up, is that parents used to say, oh, when they'd be talking to their daughters, right? When you grow up, make sure you marry a lawyer or a doctor or a stockbroker. Back then stockbrokers were well respected. But, marry this type of person. And so blue collar started, in the 90s, really it started, and it's really kind of it's accelerated since then. We started looking down on blue collar workers like, oh, don't be hanging out with a blue collar guy. You want a professional guy. Well, the problem is professional people, those jobs, there's a few that make a lot of money. Most of them don't. And you take a look at the average income, everybody wants to be a social media influencers these days. Take a look at the average income that social media influencers make. It's not the one that's, driving Lamborghinis
Right.
around.
If you're not at the far right end of the tail, you're not making a living wage. Yeah.
Exactly. And so we've done more to erode the middle class through choices and through consumerism than anything else. That's the big problem. We need to, if you want to fix this problem, go back to the roots. Start encouraging all of our kids to get jobs in areas. Look, and it's okay to go to college, but if you go to college, make sure you're getting a degree in engineering, mathematics, science of some sort, because that's where you're going to make the money to live that. And those are things we need.
Right. And I agree with you. I just want to say, look, you don't have to be a STEM person to have a good life. You can be, a strategy person. You can even be a marketing person, but get it in a field where you can create value that someone will pay you the type of wage that you want to have for, right?
Where there's demand for the jobs. And yeah, look, I've made a lot of money being in marketing. That's what you and I do, right? We market. And we've made a lot of, we can make a lot of money in marketing, but we're more of a rarity than the average, right? You want to go get a degree in a job where when you walk out of college, you're going to have a job that pays well, gives you lots of upward mobility, and is something that a lot of people are demanding.
People, yeah. Right? So I'm agreeing, and I want to say this is going to sound again like a compliment of the administration, and it's maybe a bit stretching here, but there's been a lot of rejection of kind of DEI, and it's we're now focusing again on merit, right? And you're seeing that in this new administration, and I think that is a cultural shift. You will see more, not necessarily for philosophical reasons, and however you feel about that philosophically, but as the culture wakes up, to your point, Lance, which is like, hey, we lean too far into a lot of these degrees and life paths that didn't work out. People couldn't get living wages on. And so now we need to go back to life paths that actually have marketable value, right? So I'm agreeing with everything you're saying. I think that pendulum might just shift anyways out of necessity, not so much out of ideology of just like, hey, I realized my generation, we didn't really get great jobs. So we're going to imprint on our kids, freaking learn how to weld, buddy, or learn how to code.
Yeah. And so like my son, he's learning to code. My daughter's going to school to be an anesthesiologist. I mean,
Is she really?
Yeah,
my brother's an anesthesiologist. We should connect them.
I would definitely connect them because she's all about this right now. But, but my point is that didn't come, that wasn't their decision. I literally pushed them screaming into those decisions because
you tiger mommed it.
Well, I did, because they would come to me and say, Dad, I'm thinking about studying this. I go, okay, great. Let's go online. And I'd get online with them. And I'd say, okay, go to Glassdoor or something like that, Indeed.com, and you can find the average salary for that job. And so they go, I want to do this job. It's like, great, here it is, right? How many people got hired last year for that job? A very small amount. And then, average salary, $45,000 a year. And they're like, okay, I don't want to do that anymore. Yeah. So they would come back and and we were just going through this over and over again. And they're like, well, Dad, I don't understand. And I'm like, look, I said, you've grown up in a very normal middle class lifestyle. And all your friends, because we lived out in Katy, Texas at the time, and it's kind of that, right? It's all the same type of income structure all through Katy. And I said, those are all your friends. I said, do you want to live like that? Do you want to live better than that? Or do you want to live worse than that? And they're like, well, I at least want to live that lifestyle. Okay, well, that takes this much money, and I can prove it with the math, right? I mean, we can look up the average income per zip and lay that all out. And so it took a lot of sitting down with them and talking to them and helping them understand that their choices have consequences. And while some job may sound really fantastic, oh, I'd really like to be in this or that, you got to sit down with them, show them, hey, there's a bell curve to a lot of these jobs. In a lot of these jobs, you look at the average or the median income, it's not very good. Real estate is a great example of this. Real estate and financial advisors are a really good example of this as well. The average financial advisor makes about $80,000 to $100,000 a year. Now, there's some that make several $100,000 a year. There's some that make less than that, but it's a bell curve like everything else. Just like the wealth strata in the U.S., there's 10% of the population in any job, they make a vast majority of the money, and so either you're really really good at that job, or you're going to be pretty average. And so you got to. And so we spend a lot of time with our kids, sitting down and talking to them and nurturing them and coaching them through this, because they realize that as soon as they graduate school, they're on their own. they,
Yeah.
they don't get help from us in school. They have to pay for their own school. And I get a lot of grief. It's like, I can't believe you're so hard on your kids. I want them to struggle. I want them to understand struggling. And I want them to understand the value of money. And I want them to understand that that's not the lifestyle you want. And so I have to do better in order not to live that way.
So just on that point, I'm going to put the cover of the book up here when I edit this video. But Ted Oakley from Oxbow Advisors, he writes a lot of books that he gives away for free, and they're short little books on individual topics about wealth building. And he just released one a couple days ago. I got it. It's a short book. I read it in about an hour. And it's about how to raise sort of money savvy kids. And the number one part of it is the struggle. And, he deals with a lot of high net worth clients. And he's like, I just see time and time again how parents, they're well-meaning, but they screw their kids up because they do way too much subsidization. And you either create a permanent dependent, right? Or the kids just don't learn how to develop the musculature to deal with adversity, and they go out and they just fail, and then they don't want to, they don't want to try again. Right. So yeah, that struggle point is incredibly important. And folks, if you want to read the book, just contact Oxbow Advisor, ask for it. I think they'll send it to you for free.
Okay. Speaking of, I'm actually writing an ebook for you right now on investing. A lot of the stuff that we talk about on the show, I'm decided to put it together into an ebook. So
great. That's actually excellent. I'm only laughing because it's the next evolution. If I wrote an article about it, well, I'm writing an ebook about this now. So
no, it's just as you brought it up, just reminded me. I've been working on this for the last couple of weeks, but we go through all the we do it's like you bring up something. It's like, oh yeah, I wrote an article on this. Here's the rules for this. Here's what. So I'm putting it all into one like 15-page document, all the rules, all the strategies, everything in one.
Oh, fantastic. So can we blast that out to everybody here when it's available?
Of course. Yeah.
Okay. Awesome. All right, folks. Within
4 weeks to get it put together, but yeah.
Okay.
And we'll put it out on your Substack and my Substack, and tell me to go get it.
All right. I presume we got a lot of viewers here. They're going to be waiting with bated breath for that to launch. All right. So look, we're in violent agreement on all this. I will say with my kids, I have tried to do what you've done. I've probably had mixed results so far. My older one didn't really want to hear it. I do remember when she decided to switch her major to psychology, I did send her the list of what psychology majors earn versus other majors, and it was like right at the bottom of the pack. And so, look, I'm not trying to like rain on your parade, but just be eyes wide open about this. And she's not pursuing anything, at least so far, in psychology, but she's been sort of pursuing her interest, which I think is great. But to be able to finance it, she's been doing van life. And we are at the point now where she's like, okay, I think I've really kind of figured out I want a higher standard of living when I'm 30 and 40. And so I'm now willing to kind of focus on more big girl jobs. Yeah.
And no, that's okay. See, I don't have any problem with that. I told you a story. My son at 18, he was not going to follow my rules. He packed up and moved to Germany, and it took him about 5 years, but he struggled, he suffered. I would not help him at all. And, finally he said, okay, fine, I'm going to go to school, went to school, got an engineering degree. Now he's got a good job and he's doing well, and he lives in the UK now. But sometimes they just have to do it.
But that's the struggle. I mean, a lot of times with kids being kids, it's the natural progression. You can tell them everything. They're not going to listen. They have to learn it for themselves, right?
And that's where I get a lot of grief. I'll get people emails like, well, I'll let my kid move back home after college. I'm like, you are hurting them more than you're helping them, because you have just shrunk their world of job opportunities to just around your house.
Right, down to a 10-mile radius. Yeah.
Yeah. And because that's all they're going to look, because they're living with you. Instead of you saying, no, you can't come home, now they have the whole world as an opportunity to go find something. And you've just taken that whole opportunity away from them by enabling them to come live with you while they figure it out. That's the worst thing you can do, because again, back to your point, is just sometimes they have to struggle, and it's okay. And look, and don't get me wrong. If something happened to one of my kids while they were struggling and they got really in trouble, I'm going to help them, right? I'm going to say, here, you really screwed the pooch on this one. I'm going to get you on your feet right here, but now you're done, so figure it out from here. But I'm not going to completely abandon them, but you've got to let them, it's like an alcoholic, or it's like somebody else. They've got to realize they have a problem. They've got to hit rock bottom, and they've got to want to change. And so you've got to let them struggle to figure that out.
Yeah. And we've made this analogy all the time because we're fitness guys. You don't get stronger if you don't stress the muscle, right? The muscle's got to get stressed. Okay, so folks, I promise we're bringing it back to the markets here.
That was usually at the end of the show. It's just we had at the beginning.
Yeah, it was sort of like a mid-roll rant this time around. Okay, so where to go from here?
Let's go back to
we will get to the S&P in a second, and let me just ask you this quickly before we brought it up. This was an FOMC week. I mean, the Fed didn't do anything. They kept the rate the same. They didn't alter QT at all. If anything, they took the communication as an opportunity to say things are a lot more uncertain than they've been. So we're just going to basically sit and wait to get more clarity before we decide on any course of action. I had a really interesting conversation with Axel Merck, who's a longtime Fed watcher and general Fed critic for reasons I think you would share, Lance. But he generally kind of feels like the Fed's, I mean, he criticizes the Fed because the Fed doesn't have a rules-based framework. If it did, it would be easier to say, well, this happened and therefore we're going to do X. And it's much more just sort of in reaction mode. But right now, the Fed is kind of squeezed, right? Because it's like, well, inflation hasn't hit our targets yet, and these tariffs certainly could be driving prices higher. We don't know how that's going to work out yet. At the same time, there are signs that the economy is cooling, as you've said many times. And so you can kind of make pretty compelling arguments on either side of whether the Fed should cut or whether the Fed shouldn't cut. And so until it becomes a little clearer which side is the more appropriate one, the Fed is kind of paralyzed.
That's right. And again, well, and also too, going into this meeting, it wasn't surprising that they didn't raise rates. Honestly, Trump kind of put him into a bad spot, because if he did cut rates at this meeting, then he looks like that he's acquiescing to the president, which now makes him look political, and that particularly potentially hurts.
And Trump's just been pounding him as too late, pal. That's his new moniker for him. Yeah.
Exactly. So, I don't think that was a good move on Trump's part. And it certainly put the Fed in a position to where even if they maybe wanted to cut rates, they go, we really can here. We'll wait another another 6 weeks, maybe do it the next meeting if everything kind of calms down. But I mean, there was also really no reason to cut rates. First of all, employment's fine. I wrote an article today. It's on the website talking about employment is slowing. The economy is slowing down. But there was nothing recessionary in that latest employment data. It is slowing down, but the unemployment rate is still very, very low.
Unchanged at 4.2.
Yeah, jobless claims are still running at 228,000, 220,000, extremely low. You don't even worry about jobless claims till above 300,000, so you're nowhere near that.
Right. And payrolls beat expectations. I think we mentioned that last week. Yeah.
Yeah, and then of course that first quarter GDP number, it was negative 0.3. But if you stripped out the trade deficit, it was probably close to 2% growth. So again, there was nothing. So there's really no reason for the Fed to cut rates. So it really wasn't surprising they didn't. The one thing that is running around, I've seen this a lot over the last couple of days in particular. The Federal Reserve bought about $20 billion worth of bonds at a recent auction, and I'm seeing a lot of misinformation running around. They're going, oh look, they're doing QE behind the scenes. No, they're not. They're still doing QT. But when they have a month where $25 billion worth of bonds mature and your QT is now $5 billion a month, then they have to buy 20.
You got to cover the difference to stick to 5. Yeah. To stick to -5. Yeah.
Because you're controlling the decline in the balance sheet. So, but it's not QE. They're not doing QE. They're just still mitigate. They're still running off that balance sheet through QT on treasuries and mortgages, but it's down to 5 billion. So now I kind of did expect at this last meeting that maybe they would talk about QT, maybe ending it, given all the volatility in the markets and the recent bond market, kind of spike on the basis trade, all that. They didn't say anything about it. They just said we're still doing QT. So I still think probably in the next few meetings that we may start them. They'll probably reduce QT to 0 before they cut rates. So for instance, if they're talking about cutting rates, maybe the next meeting they reduce QT to 0. The next meeting after that they cut rates. But I think they'll get rid of QT before they do rate cuts. But we'll see.
All right, let me ask you this. So if you look at the soft data, it's not good, right? Mm-hmm. Sentiment's bad and understandable. CEOs don't know what's going to happen with the whole trade war, and so they've been withholding capex and all that stuff. Households are nervous, all that type of stuff, right? The hard data has not been bad, as you've just mentioned, right? I mean, the GDP print was bad, negative, but if you back out the front running, it actually wasn't that bad. And I've heard, so Powell got asked this a lot. You had several journalists who were like, look, here's all the soft data that's bad. What else do you need to see to start taking action here, right? And Bessent's been getting hit with this too. And Bessent's answer is, look, I've been in business a lot. I've learned to take surveys with a decent grain of salt. He said, I'm not going to get worried until the hard data starts getting weak. Just asking you to guess here. What do you think is going to win out here as we get further into this year? The soft data or the hard data?
Well, the hard data is eventually going to show up. The problem with a lot of the soft data is, for instance, like the University of Michigan inflation expectations report, right? So if you take a look at that, it's got this huge spike in inflation expectations. So everybody's going, well, that's going to just mean inflation is going to go more back. Well, the problem is that data set is heavily skewed by Democrats versus Republicans. So they oversample Democrats, then the Democrats are convinced inflation is roaring back. Republicans aren't. So it's skewing that data set. So you really can't pay a whole lot of attention to that. The surveys, like the Fed manufacturing surveys, is a good example. Those are really hard to rely on in terms of data sets because again, you'll see that number, those indexes jump around a whole lot because it's like I come to Adam, I say, Adam, how's your sales this month? He goes, well, last month I sold none. This month I sold 1 unit, so they're better, right? And so it shows an improvement because it's sentiment. It's like, how do you feel about things? Oh, they're better. My new orders are better. We're not asking them though, well, how many did you sell last month and how many did you sell this month? And last month I sold none. This month I sold 1. Normally I sell 50, right? All of a sudden that number is not so great, but through the sentiment numbers, it looks like you're having this big boom and stuff. So, it's really important that you pay more attention to the hard data than the soft data, because sentiment is how do you feel about things, right? How do you feel about business? How do you feel about your outlook? How do you feel about your income? Those can change. Right now, if you take a look at the Conference Board's Consumer Sentiment Index, their outlook 1 year from now for incomes has been dropping rather sharply. So people are feeling like they're about to lose their job or they're about to, have financial troubles in terms of incomes, et cetera. But again, if something happens, that survey can change on a dime and just, shoot sharply higher next month, just because of something that happens within the media or something else. So the point is, and I agree with Besson on this, is that the soft data survey is fine. I would not put a lot of weight on that. It's something worth paying attention to. I'm not saying dismiss it entirely, but because it can and has historically translated into the hard data. We just haven't seen that to any great degree yet. We are seeing a slowdown in the data. So don't get me wrong. If we keep, we are slowing down. The economy is declining. I've written 2 articles in a row over the last 2 weeks talking about the consumers tapping out. We've talked about the employment report showing signs of economic deterioration. All that is coming to fruition, but all of that's that reversal of all that monetary input that we had back. And you and I talked about the pig in the pie, the lag effect. We just, ad nauseum talk about the lag effect. Well, here it is. The lag effect is here now.
It's finally arriving.
In the data. So pay attention to the hard data. That's the thing that's going to move the needle.
All right, and speaking of lag effects, so there is trade that is not getting done right now, right? So we've got these tariffs and the uncertainty, and there's substitution going on, right? Well, I could have bought from China, but now I can buy from somebody else, right? So it's not a, you know, it's not complete destruction, but there is trade that is not being done right now, some percent that would be done if Trump hadn't changed the rules. Um, and there's CapEx that's not being invested in right now, right? So will there be a lag effect from this where in a quarter or two or three, we'll feel the effects of the economic activity that just did not happen here in Q2?
Yeah, no, I look, we're going to go back to sub 2% growth over the course of the next couple of years. That's just the trend of where we're headed. And if you take a look at capex spending reductions, those type of things that's occurring, you're going to continue just to kind of grind slower. The thing we want to try to avoid is something that immediately causes stuff to stop, right?
Right.
And that's how you wind up in a recession and those type of things. But just given the current trend of employment growth, capex spending, productivity, all those type of things, you're going to be looking at 1.6 to 1.8% GDP growth over the next few years.
Okay. And my point was just we had that glide path starting the year, right? I think you would have said the same thing beginning of Q1, but now that we've had this crimping in economic activity, it's just going to add more headwinds to that, right? Yeah.
Absolutely.
Okay. All right. Well, look, let's pull up the charts if we can, and let me ask you the question that I asked your partner last week, Lance, which is, are you guys still in sell the rip mode?
So we're short the market at the moment. We have a short position in our portfolio, and we've already, we had sold previously, raised cash. And so right now we're kind of well positioned for where we want to be in the markets at the moment. So there's a few things that are worth kind of talking about here. So I wrote an article back on April the 7th. Now, so April the 7th, the market was, kind of at the lows. That was the low point for this whole tariff. That was April 6th was Liberation Day. April 7th, the market had crashed at that point.
Maximum freak out. Yep.
Maximum freak out. And so I wrote an article at that point. Make sure I get the right window here. All right. And this was the chart that I posted. So this is a weekly chart of the S&P 500. And so I wrote in that article, I said, we're going to get a bounce here. And that bounce will likely take us to 56, 5,700. And there's a lot of reasons for that. And part of that reason was that we're starting to trace out that 2022 type market. Now, I want to be really careful because I know how you are with headlines. I'm not saying we're about to go through 2022 again. What I'm saying is there's a lot of reasons to expect that we could see this market pull back here a bit because you've had this very sharp rally, and it's been driven by a lot of retail. Professional investors haven't really been participating. Older investors, as measured by the American Association of Individual Investors, they haven't really been participating, and they're trapped. There's what we call trap longs. People, and when you have that sharp of a decline, people didn't sell. They kept, well, as soon as it bounces, I'll sell. Well, they never got an opportunity to sell. And so now they're getting that opportunity to sell. So we may very well see some kind of selling show up in the market. So here's an updated version of that chart. It's the same chart. I've just moved it back a little bit. This is a weekly chart. And so this is a 13-week and a 34-week moving average. So the 13-week moving average is in the blue. The 34-week is in the red. So in 2022, in March, you had a crossing. This is that vertical line that you see here. You had this crossing of the 34-week moving average. That's your sell signal. Immediately after that crossing, the market rallies all the way back and gets actually above both those moving average. And this is where everybody started getting excited. It's like, oh, thank goodness the, Russia-Ukraine wars you're going to be over very quickly, whatever it is. Everybody all excited. The Fed's going to cut rates. And then the Fed comes out and says, no, we're not cutting rates. And the market sells off again.
Yeah. Sorry. That was also, though, during that period where we had Silicon Valley Bank failure, correct?
No, that was 23.
Was that 23? Okay. Sorry. Remembering the wrong year. Okay. Sorry. Scratch that.
That comes like, that's coming. That's a little bit
okay.
late. So anyway, so the market declines from that point. So here's the point. So here's today. We've had this very sharp decline, just like we had back right at the beginning of 2022. The market's rallied back. We've had the 13 34 week moving average crossover. Your MACD as at the bottom has gotten fairly oversold, starting to turn up. So this rally wasn't real surprising. In fact, this is what we wrote. It says, hey, we're going to have that. The title of that article was "The Hope and the Fear," saying that in all of this fear, there's a very, very good setup here for a market rally, and that's exactly what happened. And so now we're back to this level. So if we go back and look, what's interesting right now is that we're tracing out very, very closely.
Mhm.
The red line is the current market. I've rebased the S&P to 100 so we can have same prices.
Yep.
The black line is 2022. So we're having that first reflexive rally that you would expect to have, and we've kind of made that normal retracement. Now, every week in our newsletter, in the Bull Bear Report, we produce a weekly technical gauge, and it's comprised of 13 different indicators: relative strength, MACD, moving averages, all kinds of stuff. And what that does is tell us when markets are extremely oversold and you're most likely set up for a bounce, and also tells you when you're really overbought and why you should be taking profits and reducing risk. And so I created a comparison of that as well. So this is the same analysis chart. This is the technical gauge. And as you can see, we're tracing out almost identical to what we saw in 2022. Now, let me be really clear about this. I hate analogs. Analogs are the worst thing ever. People come out all the time and say, oh, this market's just like 1995 or 1929. Analogs are terrible. Don't pay any attention to them. I'm not using them to say this is 2022. We're about to have that situation again. What I'm trying to show you is that reflexive rallies within a correctional phase of the market are not uncommon. Markets just don't go straight down. You're going to get a bounce. So this is where, as an investor, this is where you should be looking at your portfolio and going, just a couple of weeks ago, I was about to light my hair on fire because of that sell-off in the market. I was losing all this money. I was panicking. I was sitting up at night. And now this market's rallying. You're like, woo, yay. Market's going back to new highs. Don't do that. This is the opportunity right now to go back and go, okay, I remember how I felt during that decline. That means I had too much risk in my portfolio. This is the time to start rebalancing some risk, raising some cash, taking some positions off the table that aren't working, maybe add some positions. It's okay to add some positions, but add things that have been less impacted by what's been going on in the markets. So you'll have that opportunity. Don't buy stuff that's already at all-time highs, right? This isn't the point to where you sell here and then buy something at an all-time high. Don't do that, because whatever has been performing during this whole decline, that's going to be the source of liquidity for this rally. And when the market declines, it's going to get hit as well. So, make sure that you're allocating risk accordingly. You want to buy some risk off stuff in your portfolio that, as the market starts to reduce risk, if it does, I'm not saying it is, and I'm going to show you another example here in just a second. But, if this is this type of environment where we've got more of a corrective process to go through, you want to start setting your portfolio up for that. Because again, historically, it's unusual for markets to have the decline, a near 20% decline. We were 19.2% peak to trough. It's unusual to have that big of a decline without markets having a subsequent test of some level before the correctional process is over.
All right, let me just underscore this, Lance, because I think this is so important. That this really is one of the more dangerous times for investors. Yes. From an emotion standpoint, right? And this is where your time-honored practices like really are super important. And for most people, I think this is where like a good financial advisor really earns their fees. Because it looks like you're coming out of the darkness, right? You've been beaten up. You're sitting there, ready to put your head in the oven. I can't believe I wrote this thing down. Please, Lord, please get me back to even, and then I'll sell. And then the market, comes back faster than you thought. And then you're right at that point where sentiment shifts from despair to FOMO of, oh my gosh, like this thing, we made it through. This thing's about to break through these key resistance levels. Like this is, I'm all of a sudden reading a lot of really positive headlines, and I want to be part of this, right? I'm so lucky I just got out of the basement, but now I've got the opportunity to go to the moon, right? And this is where people kind of push their chips on the table. If this is one of these reflexive rallies that then corrects again, it's the exact wrong time to do that, right?
Yep.
Yeah. And so you need to have that discipline to say, well, okay, maybe I'll still keep some positions on the long side, but I'm going to take some gains. I might put some hedges on my portfolio, whatever, all the things that you said you're doing, and we'll get to your specific trades in a moment, but like it's right here, if indeed things play out the way you think you're going to, where people's emotions and their own, mental thought process tends to be their worst enemy.
Yeah. And look, and so you just said something very important, and I want to emphasize this. I'm not saying that I know what's going to happen. I've laid out the case for you just a second ago as why we could be looking a lot like 2022 to some degree. And again, I don't expect that close relationship to remain forever, but it is right now. But again, if you look at, so this is just a daily chart. But if you look back at 2023, we had a correction. We were down. That was the summer in 2023 that we were down about 10% peak to trough during the summer. This was the AI trade was dead. This was just coming after Silicon Valley Bank in March. And, we had the bank term funding program in place, but AI was dead. NVIDIA was down, the whole trade was over for AI stocks. You don't want to be in them anymore. It's, it was all a fad, those type of things. And so the market was down 10%. We violated those daily moving averages. We violated the 50-day. We violated the 200-day. We did everything potentially wrong that we could do wrong in the market. Had the death cross in the markets. The market bottomed in October and then went straight back up. So this is what I'm saying is like right now, let me zoom in here a little bit. So right now we've done everything wrong. We've got the death cross, the 50 below the 200-day moving average. We've got the 20-day below the 50-day. We've got all these things going on. And so we've have gone through this whole corrective process, and now this market's rallying. So it's possible. It is possible, entirely possible, that something could happen next week. Trump comes out and says, I'm just making stuff up, right? Over the weekend, me and the boys got together. We cut trade deals with every country in the world. And here's what the new tariffs are. And we're done, right? And man, this market's going to take off running. Or the Fed comes out next week and says, emergency rate cut, 50 basis points, right? This market's going to take off running. Something can happen that can cause this market to just shoot off to the moon. And that's okay. But this is why you never go to 0% exposure, because if that happens, it's too hard to get back into the market. It's like, oh man, I missed it. How do I get back in? This is why you always maintain some exposure to the markets, just like we have now. So for us, all we have to do is if the market does what I think it'll do, and I do think we're going to get a correction, at least back to support, somewhere around this 5,300 level. I think that's a reasonable possibility, somewhere around the support level. But if we break through this resistance level, which is just above us at about 5,800, we get above 5,800, there's nothing stopping the market to go back to all-time highs. Mm-hmm. All I have to do at that point is remove my short position and put my cash back to work. Easy. I just buy stuff I already own, add to those positions, maybe add one or two new positions that I like, whatever the reason is. But mostly the first step is just pull the short off. And so I just remove that boat anchor and then let the market run, and the portfolio performs fine. But for people that have gotten all the way out of the market, and I've talked to a lot of people that have done just that, they're going to have a very, very, very tough time getting back in the market if this market breaks out to the upside, because now they're in the chase, and now they're going to be going, well, it's gotten away from me. I got to wait for a correction. And then if you go back, if you kind of go back and look at when we did this previously, we, broke below all these moving averages. I'm out.
Right. You didn't get it for a year, and it still was way higher. Even when it corrected to a point way higher than where the bottom was. Yeah.
It was very, very difficult to get back in. So this is why managing risk is so important. It's not managing your portfolio is not being all in or all out. It's about managing your risk and managing your exposure. And it's okay. Right now, we're taking a little bit of a performance drag on this rally. But, if this rally fails, that's okay, because I've got portfolios protected, and it's really easy to flip portfolios back around once I'm in a better position to know what kind of expect what's going to happen next. Right now, I'm just guessing. We've
Right.
got 50% chance it goes to the upside, 50% chance it goes to the downside. Flip a coin. I have no idea how this works out.
Right. But because you outperformed so far this year versus your benchmarks, you've got some slack to be able to play it safe with, which is a great position to be in, right?
Yeah, portfolio
Um,
positive for the year. So I've got a gain for this year so far. It's about 80 basis points, but the S&P is still down 4 for the year. I haven't looked today where we are, but we're down 4% for the year on the S&P. So yeah, I've got some room. I got some wiggle room, as they say.
yeah. Well, you got a way to play it safer, and you know, uh, do the right thing. So if you're wrong, quote unquote, you're wrong, you still have that wiggle room, that buffer. If you're right, your outperformance gets a lot better.
Right.
Let me just make one point here too. So you talked about the person that got all the way out back in October of 2023. And then the market ticks off and they said, okay, well, I got to wait for a correction to get in now, right? So the market goes higher, 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 right? Like a lot higher. What, did 50% higher, right? And you're killing yourself during that period. Like, oh my God, when is this thing going to correct, right? And then it corrects, right? How many of those people had the fortitude to buy in at 5,000? Zero, right? Because it feels like the world's ending, right?
Yeah.
So you're like, I'm not going to catch this falling knife, right? And then the market rebounds, and to your point, it could continue to power higher from here, right? So it is, to your point, it's super hard once all your chips are off the table to get them back in if the market has moved on you.
Yeah, and it's always the case, right? So the market finally corrects. Well, now it's going to go to zero, right? So now I'm going to wait to buy it because now we're really I told you this bear market was going to happen, Adam, and so when this bear market's over, then I'm going to be buying in. I'm going to put all my chips to work, but then the market takes off rallying, and it's like, oh, well, the problem is they're like, here's the correction, but they never identified what level it was that it was a good value to buy, right?
Right.
So, this is the problem with just managing money emotionally is that you finally had that correction you were looking for. You gave up about half the gain that you gave up previously, but you still didn't buy in. And now you won't buy in because now you're expecting the market to come back down and go lower. And so you keep talking yourself, you're rationalizing yourself into making these investment mistakes over and over and over again. And that's the hardest part about managing money is just the emotions of it.
Right, which is again why you either want to like get real experienced as a good DIY investor in managing your emotions, which I think most people aren't well suited to do, or you find a good advisor who provides that discipline for you. I'm going to steal a motto from the lottery, which I hate. I hate lotteries, but there's that expression: "You can't win if you don't play."
Right.
And that's very true in financial markets when you're trying to grow your wealth over time, right? Is you got to be in them. Now, that said, this is why I'm such a big proponent of risk management. Lots of reasons to be concerned. There are lots of things that could happen. Markets right now, richly valued still, even with the correction we've had this year. So there are lots of things that you can do. And I talk about them with you, Lance, and I talk about them with the other advisors here. To be able to give you some downside protection if indeed the market does something you don't think it's going to do. But, in very rare cases, would I say the right step is to be 100% out of the market for the reasons that we just talked about. One, you can't win. I mean, you can only win if it goes to zero. You only win if you happen to go to full cash. If we have the kind of, market implosion that I understand some people think will happen, but the odds of getting that timing right are pretty darn low. So you're better off, I think, long term being in, but having lots of safeguards. And like Lance and New Harbor, have your portfolio breathe. There are times when you want to have less equity exposure than more. But going to zero, as Lance has said many, many times, can be a real dangerous step because it's super duper hard to get back in for the reasons we talked about. All right, Lance, well, look, we are getting near the end of our time here. What trades have you guys made, if any, over the past week?
We didn't do any of this last week. Again, we're kind of in this spot to where do we add to the short? Do we remove the short? Right? Because we don't know kind of really what the market's going to do next. And,
But you're keeping it for now, right?
yeah, no, we're keeping it for now. We haven't done anything, but that's
Yeah.
the that's the conversation we're having right now, is that, we're looking at the markets, and markets are not overbought. They're not exceedingly, bullish yet. In other words, if you take a look at the bulls and the bears, both professionals and retails, it's recovered some, right? But we're not back to really bullish levels in the market. So again, the one, as we talked about before, is that the one kind of key gauge, if you're going to watch any gauge, is watch investor sentiment. When it gets super negative, that's a good indication to go buy stuff, because when every headline in the media is negative, and every article you read is negative, and the world's going to end, and that's just, the end is nigh. When you start seeing that kind of stuff, generally that's a great time to start buying stocks. When everything's honky dory, that's a good time to start selling stuff. And we talked about, I wrote this article. I've been on a Star Trek kick lately. I don't know why, but sorry.
Which
one?
Original, Next Generation?
Original, of course.
Okay.
Of course, original. Well, and a little bit of, actually, I should say that, because I actually did bleed over into a little bit of the Next Generation with Jean-Luc Picard to talk about the Borg. That was an article I wrote last Monday called "Resistance is Futile."
Yeah.
Talking about resistance levels. And you have resistance on top and bottom. We call them support, but it's just resistance to lower prices. And so you need to pay attention to these things, and develop this kind of attitude. But we talk about this bell curve of outcomes, and generally when you start reading articles about the end of the world as you know it, those things never happen. Just like economic perfection is never going to happen, right? So those things are things that you can put out there, but they're at the very tail end of that bell curve. And so we want to focus on managing our risk within the odds of things that are most likely to happen, which are generally corrections of somewhere between 5 and 10%. 20% corrections happen about 13% of the time historically. So they're low probability events to have 20% corrections. We got right up on it, right? 19.2, we're right there. But those are lower probability events. So it's really hard. It's detrimental to your portfolio to bet on outcomes that have a very small percentage chance of an outcome, right? So you really want to kind of stay within the majority of that bell curve. Say, okay, most of the time I'm going to get somewhere between an 8 and 12% rate of return to the upside, and my max draw on the downside is probably going to be around 10. And if I can live within that range and navigate that risk, you're going to win more often than you're not. And then you just have to worry about those tail risk and just hedge for those in your portfolio as you go along.
Okay. All right. Well, look, we're going to have to wrap things up, but Lance, great to have you back. Yep. Great week. Folks, if you think one of the best ways to position your portfolio smartly for what's going to happen next year is to make sure you continue listening to the mellifluous Lance Roberts every week here on this channel. Please let him know that by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. If you would like some help in figuring out how to position your portfolio for the road ahead, particularly if the things that Lance thinks have a higher probability of happening do indeed happen. First off, highly recommend that almost everybody watching this video, unless you've got a really good, successful track record as a DIY investor in volatile times like this, recommend that you work with a good professional financial advisor who takes into account all the things that we talked about here. If you've got a good one who's doing that for you, great, stick with them. If you don't, consider scheduling a consultation with one of the financial advisors that Thoughtful Money endorses. These are the firms you see with me on this channel week in and week out, perhaps even Lance and his team there at Real Investment Advice. To set up one of those free consultations, just fill out the form at thoughtfulmoney.com. There's no commitment involved to work with these investors. It's just a service they offer, and they'll be in touch with you right away as soon as you fill out the form. Lance, my friend, always great. As usual, I'll give you the parting words of advice here.
Yeah, and next week we have a spelling test for all these words that he comes up with. So
yeah. I probably, even though I'm coming up with them, I don't even know if I would pass that spelling test.
In other words, when you log on to Thoughtful Money, you'll have to have a spelling test to get into the show. So we're gonna have like a pass.
Maybe if you get triggered and you want to leave a flaming comment, that's going to be like the CAPTCHA thing. You have to spell the word right before you can do it.
And look, and again, it's okay if you disagree with Adam and I. Absolutely. And you should disagree with us on a lot.
And we disagree with each other, as folks just saw in spades in this interview.
But don't let it upset you. Just realize you disagree. And then again, when Adam disagrees with me, I have to think about, I never agree with him, but the point is that at least, I take what his comments are, and at least I try to evaluate them for, the value, right? And if you'll do that, you'll come out better. I mean, just getting upset and not listening, that doesn't help. That doesn't help you be better at anything, whether in life or in just living. Honestly, it's just, life is too short to live upset. So just, you know, take it for what it's worth and then move on.
Yeah, and what's really interesting about this, and I won't get too derailed on this, but culturally we've become more divided than we've ever been, and some of that's because of these devices. A lot of it's been about how just politically polarized things have been. And Bill Maher, who is not a fan of Trump at all, said an awful lot during this last election. He's like, look, you gotta learn to talk to the other people, because he said, look, right now the country's kind of split down the middle. The other 50% is not going to self-deport, right? They're going to be here. We just have to learn how to live together, which is how we used to do in previous generations. And I was just talking yesterday, kind of on this topic. We've talked in the past, Lance, about that we're kind of both fans of national service,
Mhm.
right? Whether it's military service for a couple of years, or Teach for America, or AmeriCorps, or something, right? Where you are investing in the foundation of the country that provides all the benefits that you get to enjoy by living in it as a citizen. And there's a whole bunch of reasons why I'm for that, but a really big one is the fact that you will go and work alongside other people from different parts of the country who think differently from you.
Mhm.
And you will, by interacting with them, learn that they're real people and humans, and they're not evil, even though they might share different opinions, right? And you
Right.
will learn that you will learn from them, but you will also learn that we can disagree, but still be friendly with each other and work together, right?
Well, that's the whole difference between, when we were growing up in the 60s, 70s, 80s, the only way that you communicated with other people was in person. There wasn't sitting behind a screen sending mean tweets to people you don't know. It just
Right.
didn't exist. And if you were going to disagree with somebody, you had to have the cojones to step up and say it to their face, right?
Face.
And that changed a lot of dialogue. We're just like, I'm not going to really say that to that guy.
Yeah. Well, so everybody should, what are they saying now, which I really like, is everybody should just go and touch grass more often, right?
Yeah.
Like just get out in the real world, touch grass, talk to a real person, all that type of stuff. All right. Very last thing, folks, too, if you are interested in participating in Rick Rule's Gold Bootcamp, go sign up for that over at thoughtfulmoney.com/rule bootcamp. All right, my friend Lance, it's been great. Thanks so much, buddy. I'll see you next week. Everybody else, thanks so much for watching.